The numbers are staring us right in the face, but nobody wants to see them. While everyone's celebrating record highs and talking about soft landings, the financial system is sending distress signals that make 2008 look like a practice run. What we're facing in 2026 isn't just another recession. It's the convergence of 4 separate crises that will create a perfect storm unlike anything we've witnessed in modern history. Let me start with something that should make your blood run cold. The Shiller PE ratio just hit 40.23. That's the price-to-earnings ratio adjusted for inflation cycles, and right now it's sitting at the second highest level in 140 years of recorded data. The only time it was higher was December 1999, right before the dot-com crash erased 80% of the NASDAQ and sent the S&P 500 tumbling 50%. But here's what should terrify you even more. In 1999, we had one bubble bursting in one sector. In 2008, we had one crisis centered on residential real estate. Today, we're facing 4 interconnected crises that are about to explode simultaneously, and each one feeds into the others like gasoline on a fire. Let me walk you through each crisis, and once you see how they connect, you'll understand why this isn't fear-mongering. This is mathematics. Crisis number 1 is the commercial real estate apocalypse. Are you ready for this number? $936 billion. That's how much commercial real estate debt matures in 2026 alone. Add the $525 billion that matured in 2025, and we're looking at nearly $1.5 trillion in loans that need refinancing at interest rates roughly double what borrowers originally paid. Here's the brutal math that breaks everything. A building financed in 2021 at 3% now needs to refinance at 6% or higher. That literally doubles the debt service payment overnight. But wait, it gets worse. The building's value has plummeted because office vacancy rates have exploded to 20% nationally. San Francisco is approaching 30%. Austin hit record highs. So borrowers face an impossible situation. They owe more than the building is worth, their payment just doubled, and they can't sell because nobody's buying. What do? They hand the keys back to the bank and walk away. We're already seeing this tsunami building. CMBS delinquency rates hit 6.59% in the third quarter of 2025. For office properties specifically, the distress rate reached 10.9% in October, up from 6.7% just 2 years ago. 278 banks have been identified as vulnerable due to concentrated commercial real estate exposure. Over 900 banks still carry commercial real estate exposure above 300% of their capital. This is the same mechanism that destroyed the banking system in 2008, just with a different asset class. Back then, banks loaded up on subprime home loans. Today, they've loaded up on office buildings and retail centers that are going bad. The banking system absorbed roughly $400 billion in losses during the Great Financial Crisis. Commercial real estate losses in this cycle could easily exceed that number. Crisis number 2 is the everything bubble in stocks. That Shiller PE ratio of 40 isn't just high, it's historically catastrophic. When CAPE ratios have exceeded 30 for extended periods, markets have always experienced corrections of 20% or more. At 40, we're not pricing in growth. We're pricing in absolute perfection, and perfection doesn't exist in financial markets. The Buffett indicator, which compares total stock market capitalization to GDP, is sitting at 225%. The historical average is 80 to 100%. Anything above 160% is considered significantly overvalued. Warren Buffett himself said that ratios approaching 200% mean investors are playing with fire. We're at 225%. But here's the concentration risk that makes this even more dangerous. 7 stocks, the so-called Magnificent Seven, now represent over 30% of the S&P 500's total market capitalization. Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, Tesla. If these 7 stocks correct, the entire market follows. This isn't diversification. This is concentration, masquerading as an index. The AI boom driving these valuations mirrors the internet boom of the late 1990s perfectly. Revolutionary technology, real productivity gains, massive investment, and parabolic stock prices. Then a crash that wiped out trillions in paper wealth. The question isn't whether AI is real. It is real with enormous growth potential, just as the internet was real back in 2000. The question is whether current prices reflect reality or fantasy. At 40 times cyclically adjusted earnings, fantasy is winning. Before moving forward, if this video made you stop and think, then the conversation doesn't end here. Leave a comment below and tell me what topic you want us to go deeper into next. This channel exists to break down what most people are never told, and your questions shape what comes next. If you want to understand these shifts before they become obvious to everyone else, make sure you subscribe, like this video, and turn on notifications. Because what's coming won't be explained on the evening news, but it will be explained here. Crisis number 3 is the debt doom loop that's about to strangle the government. $38 trillion. That's the current national debt as of January 2026. We've added roughly $2 trillion per year in new debt. But here's the number that should keep you awake at night: $1 trillion. That's what the federal government paid in interest on the debt in fiscal year 2025. Think about that for a moment. Interest payments are now the second largest line item in the federal budget, behind only Social Security and larger than Medicare or defense spending. The Congressional Budget Office projects interest payments will hit $1.8 trillion annually by 2035, but that assumes interest rates decline. What if they don't? What if they rise? Every 1% increase in average rates adds roughly $380 billion in annual interest expense. The debt doom loop works like this. High debt requires high borrowing. High borrowing puts upward pressure on interest rates. Higher rates increase interest expense. Higher interest expense increases the deficit, and higher deficits require more borrowing. The cycle feeds on itself until something breaks. Here's what makes 2026 particularly dangerous. The debt ceiling was reinstated in January 2025 at $36.1 trillion. We've already blown past it. Another debt ceiling showdown is coming, and another credit rating downgrade is possible. Moody's already cut the U.S. from its highest rating in May 2025. We're running out of runway. The 2008 crisis was triggered by private sector debt. The next crisis will be triggered by sovereign debt, and that's harder to fix because the entity that normally does the fixing is the one that's broken. Crisis number 4 is the consumer breaking point, and the warning signs are everywhere. $1.66 trillion in auto loan debt with an average payment of $748 per month. Subprime auto delinquencies at 6.65%, the highest since tracking began in 1994. 1.73 million vehicles were repossessed in 2024, the highest since 2009. Here's what should terrify economists. 28% of trade-ins are underwater, meaning people owe more than their cars are worth. Average negative equity is $6,900. Nearly 1 in 4 underwater borrowers owes more than $10,000 on cars worth less than their loans. Credit card debt exceeds $1.1 trillion with average APRs above 20%. Delinquencies are climbing steadily. Student loan payments resumed after years of forbearance. The average American consumer is completely tapped out. Car loans are typically the last payment Americans skip before the mortgage or credit cards. The car payment comes first because you need the car to get to work. And when car loan delinquencies spike, it means consumers have exhausted every other option. They've cut spending, maxed out credit cards, and depleted savings. They're at the end. Subprime borrowers aren't marginal players. They're the canary in the coal mine. When they break, it signals stress that will move up the income ladder. Right now, subprime is breaking at rates not seen since 2008. Now let me show you how these 4 crises connect, because individually, anyone might be contained. Together, they create feedback loops that amplify each other into something catastrophic. Commercial real estate losses hit banks, so banks tighten lending across all categories. Tighter lending slows the economy, increasing unemployment. Higher unemployment means more consumer defaults, which means more bank losses. The cycle accelerates and feeds on itself. Simultaneously, if stocks correct 20 to 30%, the wealth effect reverses. Consumers who felt rich because their 401k was up suddenly feel poor. They cut spending, business revenues drop, corporate earnings fall, leading to more layoffs and more defaults. The stock decline becomes self-fulfilling. Through it all, the federal government seeing it stimulate like it did in 2008 or 2020 because it's already running $2 trillion deficits at full employment. Interest payments already consume $1 trillion. There's no fiscal space left. The Federal Reserve can't cut rates to 0 again because inflation isn't dead. It's still above the 2% target. The Fed is trapped between fighting inflation and preventing recession. It can't do both effectively. In 2008, we had 1 crisis and unlimited policy ammunition. In 2026, we have 4 crises and no ammunition left. That's why 2026 could be exponentially worse than 2008. Let me destroy the common objections you're probably thinking right now. First objection: the economy is resilient. GDP growth is positive, unemployment is low. GDP was positive in 2007 too. Unemployment was low in 2007. Stocks were at all-time highs in October 2007. The economy looked fine until it didn't. Recessions are only visible in hindsight. By the time the data confirms a recession, you're already 6 months into it. The indicators I'm showing you are forward-looking. They're telling you what's coming, not what's already here. Second objection: banks are stronger now with more capital and tighter regulations. Banks have more capital for the risks regulators anticipated. They don't have capital for concentrated commercial real estate exposure at this scale. 900 banks with CRE exposure above 300% of capital. 278 banks already identified as vulnerable. The regulatory framework was designed for the last crisis. It always is. The next crisis finds the gaps. The yield curve has been inverted since August 2022, deeper and longer than most people alive have ever seen. This isn't just any indicator. It's predicted every major recession for the last 100 years. In 1928, it inverted before the Great Depression. In 2000, before the dot-com crash. In 2006, before the housing crisis. Now it's inverted again, and deeper than almost any previous time. The pattern is always the same. Inversion happens, markets rally for another year or two while experts say it's different this time. Then reality hits like an avalanche. We're in that rally phase right now, that dangerous period of false confidence that comes right before the breaking point. What's different this time is the scale. The total wealth stored in global financial assets is about $250 trillion. If even 20% of that evaporates, and that's conservative, we're talking $50 trillion gone. That's 50 times worse than 1929 in absolute terms. The psychological damage will be unprecedented. An entire generation watched their parents lose everything in 2008. Now they're about to watch their own savings disappear. The trust in the financial system won't just crack, it'll shatter completely. When people stop believing money has value, that's when things get medieval. But here's what nobody wants to talk about. The yield curve inversion is not just deeper than 2008, it's deeper than 1929. It's been inverted longer than anyone alive has ever experienced. Yet, just like before every major crash, the surface looks calm. Stocks are rallying, unemployment is near record lows, the economy appears strong. This is the same illusion we always fall for. The calm before the storm, the false confidence that comes right before the breaking point. Because when the yield curve stays inverted for this long, it's not a false signal. It's the sound of pressure building, the moment before something snaps. Back in the 1970s, yield curve inversions led to recessions almost instantly. But today, things have been strangely different. When oil prices spiked in 2022 because of the war in Ukraine, the world braced for another 1970s-style crash, and it never came. Why? Because consumers still had more than $2.5 trillion in extra savings left over from pandemic stimulus. That cushion acted like armor, hiding the damage underneath. People kept spending, businesses kept hiring, and it looked like the economy was invincible. But those savings are disappearing now. Credit cards are full, delinquencies are rising, and that invisible shield protecting the system is fading fast. When it's gone, the real impact will begin. The danger isn't just the inversion itself, it's what it represents. Think of the yield curve as a map of time. Normally, investors expect higher returns for lending money longer because the future is uncertain. But when they start demanding higher rates for lending short term, it means they're terrified of what's right in front of them. They would rather lock up their money for 10 years than lend it for 6 months. That's how deep the fear runs. And the deeper that inversion goes, the worse the crash that tends to follow. In every single case from 1929 to 2008, the depth of the inversion predicted the depth of the recession. Shallow inversions led to mild slowdowns. Deep ones destroyed economies. Today's inversion is one of the deepest ever recorded. If we trace the pattern, the 1928 inversion led to a crash about 17 months later. The 2006 inversion led to one 16 months later. If history repeats, that window would place the danger zone right now. The setup is nearly identical. Low unemployment, high optimism, and a stock market that refuses to believe in gravity. In both previous times, people thought the inversion had failed because nothing happened right away. But when the breaking point came, it hit like an avalanche. What happens next will depend on how long this illusion of strength lasts. The longer it holds, the more violent the release will be. History has never seen a soft landing from a yield curve inversion this deep. Never. And that's why pretending it's different now is perhaps the greatest mistake of all. The bill for 20 years of easy money is coming due. 2026 is the year the check arrives. Will you be ready to pay it, or will it be paid with your wealth? The data is screaming, the warning signs are flashing, and the people who prepared for 2008 before it happened were the ones who prospered after. The choice is yours, but the math is unforgiving. You cannot defy gravity forever, and when you're this high up, the fall hurts exponentially more. The yield curve doesn't lie, the debt numbers don't lie, and history doesn't lie. What's coming will not just repeat history, it may rewrite it entirely. Third objection. The Fed will save us by cutting rates and printing money. The Fed's balance sheet peaked at nearly $9 trillion. They're trying to shrink it. Inflation remains above target. Cutting rates aggressively risks reigniting inflation. Printing money when debt to GDP is already 120% risks a currency crisis. The Fed's tools are designed for deflationary recessions. What happens when the crisis is inflationary? What happens when rates can't go to zero because inflation won't let them? We're about to find out. Fourth objection. This time is different because AI will drive productivity gains and technology will save us. The internet was going to save us in 2002. Real technology, real productivity gains. Stocks still crashed 78%. The technology was real, but the valuations weren't. AI is real. NVIDIA's revenue growth is real, But when CAPE hits 40 and the Buffett indicator hits 225, you're not paying for technology. You're paying for a story. Stories don't have earnings. Eventually, reality intrudes. So what do? Here are 6 steps to survive 2026. First, stress test your portfolio for a 30 to 40% drawdown. If you can't stomach that loss, reduce exposure now, not after it happens. Second, build cash reserves. 6 to 12 months of expenses minimum. In a credit crunch, liquidity is king. The people who had cash in 2008 and 2009 bought assets at generational lows. Third, reduce exposure to rate-sensitive assets. Long-duration bonds, highly leveraged companies, commercial real estate, anything that breaks when rates stay higher for longer. Fourth, diversify geographically. International markets are trading at significant discounts to U.S. markets. The Shiller PE for international developed markets is roughly half the U.S. level. When the U.S. corrects, capital flows elsewhere. Fifth, own hard assets. Gold hit record highs in 2025 for a reason. Central banks are buying at the fastest pace in decades. They're diversifying out of dollar assets. Maybe you should too. Sixth, pay attention to the signals. Watch CMBS delinquency rates, auto loan delinquencies, the yield curve, and bank earnings. When these deteriorate faster than expected, the timeline accelerates. The mainstream forecast is for a soft landing and mild slowdown. No recession, moderate growth. That's the base case, but base cases assume nothing goes wrong. Right now, 4 major systems are all flashing warning signs simultaneously. Commercial real estate, $936 billion maturing in 2026. Banks exposed, values falling. Stock market, Shiller PE at 40, Buffett indicator at 225. Concentration in 7 stocks. Government debt, 38 trillion total, 1 trillion in annual interest, debt ceiling drama ahead. Consumer stress, record auto delinquencies, record negative equity, record repossessions. Any one of these could be the trigger. All of them together create conditions for something worse than 2008. Not because any single crisis is larger, but because the system has no shock absorbers left. 2008 had a crisis and a massive response. Fiscal stimulus, zero interest rates, quantitative easing, bank bailouts. Every tool was deployed. 2026 will have a crisis and constrained responses. High debt limits, fiscal stimulus, elevated inflation limits rate cuts. Political dysfunction limits coordinated action. The tools are duller, but the problems are sharper. Here's the uncomfortable truth. Nobody knows exactly when this breaks. Could be first quarter 2026, could be late 2026, could be 2027. The timing is uncertain, but the direction is not. You cannot run a 40 Shiller PE, 225 Buffett indicator, 1 trillion in annual interest payments, 20% office vacancy, and record consumer delinquencies indefinitely. Something gives. The question is whether you'll be positioned to survive what's coming or whether you'll be another casualty of the next crisis. The data is public, the warning signs are flashing, and the experts who missed 2008 are telling you everything is fine. You have to decide who to believe. Let me add one more layer to this analysis, the historical pattern. Every major financial crisis follows the same sequence: excess, euphoria, exhaustion, collapse, reset. We've seen it in 1873, 1929, 2000, and 2008. The names change, the assets change, but the pattern doesn't. In the 1870s, the excess was railroad speculation. In the 1920s, it was stocks on margin. In 2000, it was internet companies with no earnings. In 2008, it was mortgage-backed securities with fake ratings. In 2026, it's AI stocks at 40 times earnings, commercial real estate refinancing at double rates, government debt approaching 40 trillion, and consumers maxed out on everything. The euphoria phase is always the same. This time is different. We've evolved past the old rules. Technology changes everything. Smart people are in charge. The new paradigm. Then exhaustion. The first cracks appear. Subprime goes bad. A lender fails. Delinquencies tick up. But experts say it's contained, isolated, not systemic. Then collapse. What was contained suddenly isn't. What was isolated becomes interconnected. The fire spreads. Then reset. Prices fall to levels that make sense again. Assets transfer from weak hands to strong hands. The cycle begins anew. We're in late euphoria, early exhaustion right now. The cracks are appearing. CMBS delinquencies, auto loan defaults, bank vulnerabilities. But the experts still say contained, still say isolated, still say this time is different. The pattern says otherwise. The pattern is never different. Only the names change. In 2008, Lehman Brothers collapsed on September 15th, but the warning signs started in 2006 with rising mortgage delinquencies. 2 years of warning that most people ignored because the experts said contained. The warning signs for 2026 started in 2023, commercial real estate stress, consumer delinquencies, bank earnings pressure. We're 2 years into the warning phase. The question is, how much longer until the Lehman moment arrives? I'm not predicting a specific date because nobody can, but I'm saying the conditions exist. The fuel is stacked, the kindling is dry. All that's missing is the match, and in financial markets, matches always appear eventually. The prudent response isn't panic, it's preparation. You don't have to time the exact moment of crisis. You have to be positioned so that when crisis arrives, you're not destroyed. You're ready to take advantage. Cash provides optionality. Low debt provides flexibility. Diversification provides protection. Hard assets provide insurance. These aren't predictions, they're preparations. 2026 may be the year everything breaks, or it may be the year everything holds together through another round of extend and pretend. What I know for certain is that the risks are elevated, the warning signs are flashing, and the people who prepared for 2008 before it happened were the ones who prospered after. The choice is yours. Believe the experts who say soft landing, or believe the data showing Schiller PE at 40, CMBS delinquencies at 7%, auto defaults at 30-year highs, and $1 trillion in annual interest payments. The experts have a track record. The data has a track record. You decide which one to trust. But here's what makes this moment even more dangerous than 2008 or 1929, the scale of interconnectedness. In 1929, most Americans didn't own stocks. Only 2 to 3% of the population was in the market. When Wall Street imploded, it hurt, but most people's life savings were under mattresses or in local banks. Today, over 58% of Americans own stocks through retirement accounts, pensions, or direct investments. Even if you don't own stocks directly, you're still exposed through your employer's 401k match, your insurance company's reserves, your local government's pension obligations. There's literally no escape hatch this time. We have turned the entire middle class into involuntary day traders and then acted surprised when the house always wins. In 1929, total U.S. debt was about 160% of GDP. Today, we're pushing 350%. That includes everything: student loans, credit cards, mortgages, car loans, government debt. We've built a civilization on IOUs. The derivatives market has exploded to over $600 trillion in notional value. The entire world GDP is around $100 trillion. We've created more imaginary money than real money by a factor of 6. It's like writing checks from a bank account that doesn't exist and hoping nobody notices. Warren Buffett called derivatives financial weapons of mass destruction back in 2002, when the market was worth $100 trillion. Now it's $600 trillion. We didn't defuse the bomb. We made it 6 times bigger and added a timer. Here's the demographic time bomb nobody talks about. 10,000 baby boomers retire every single day. That's 10,000 people shifting from buy stocks mode to sell stocks mode every day for the next decade. That's not a headwind, that's a Category 5 hurricane. Plus, we have $4.5 trillion in corporate debt maturing between 2025 and 2027. Companies that borrowed money at 2% interest now have to refinance at 6 to 7%. Imagine your mortgage payment tripling overnight. That's what's about to happen to half of corporate America. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.